Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain, with me Saisha Faridi, and there's green on the screen today. So that's the happy news that we have to share because the Nifty is holding on to the green even though it's off the highest point of the trading session, at least 23,700 thereabouts is something that we've managed to scale on an intraday basis and largely holding on to gains even though there's a smidge of a drop from the highest point. We're likely to close in the green if we continue this path, and this will be after 7 sessions that we have closed in the red. So definitely can do with some of the green on the screen. It's auto sector which is leading the pack thanks to that big move on M&M. Real estate stocks are doing quite well in the trading session, and in IT, after getting beleaguered yesterday, is bouncing back today. So Infosys, TCS, these are the names which are leading the gains. The other bit to watch out for is the insurance companies. They are coming under quite a bit of pressure. So whether it's in HDFC Life, whether it's in SBI Life for that matter, whether it's Max Financial, ICICI Pro, ICICI Lombard, these all will come up for you on the screen. And these are the stocks which are actually down and out, and that's because there was that comment that came in from the finance minister which asked the banks to actually focus on their core banking parameters and the activities, and not too much to the allied services. And we all know that for insurance, bank is one of those important channels from where they get the clients and funneling happens. So perhaps there is that worry that is impacting the street mood on insurance companies. In fact, why not we listen out to what exactly the finance minister had to say on the subject.
Trust should be built by the way you offer your portfolios, by the way you offer your service, and by the way you look at each customer's requirement without clubbing them into one class, particularly in the context where banks facilitate the distribution of insurance products. I wish to say this for due consideration of the bank's boards. While this model has significantly contributed to improving insurance penetration across the country, it has also raised concerns about instances of misselling, and I would say added or contributed in indirect ways of increased cost of borrowing for the customers. So banks will have to look at it with a lot more emphasis on their core banking activities and not burden customers with insurances which they don't require. So banks must prioritize on transparency, ethical practices, and clear communication strategies for us to earn the trust of the people.
Well, getting thrashed for the insurers, but that's not quite the case with the rest of the market. What a solid rebound is what you have at your hands. And then, of course, there are names like Indian Hotels as well, which haven't really fallen in the recent market correction and continue to accelerate further. And now you've got this Accelerate 2030 strategy as well, which was unveiled. We're going to be chatting with Puneet Chatwal as well just shortly on the show. They're going to be focusing on new brands, new segments, industry-leading margins and returns is what they're aiming at for 2030. They're looking at doubling their portfolio, 700 plus hotels, the ROCE to be about 20% plus range, and 2x growth in the consolidated revenue is what they're targeting for 2030. That stock holding up very, very smartly. And today, of course, the move in the market is accelerated. Autos are doing very well. M&M, Tata Motors, both those stocks holding out very well. A trend after the recent correction in the stock price, that's rebounded about 2.5% as well. There's Titan, which is looking good. HDFC Bank is powering ahead by 2%. And then IT, which was actually a laggard yesterday, those stocks as well rebounding quite nicely. Nishal Maheshwari on the show. And of course, we'll have our chartists as well shortly join in. Nishal, hi, afternoon. Does it seem like we're at least close to a durable bottom? And does it seem like today's rebound looks meaningful?
Hi, afternoon, Aisha. I think for the moment, because market was so oversold for the last 7 or 8 days, we were in the negative. I think this is more of a rebound rally, basically, which I see. Whether it's going to sustain or not, I think if you look at it, none of the fundamental reasons have changed. The dollar still continues to remain as strong as ever. There is a bit of uncertainty in the US policies, basically, because still the new president comes into in mid-Jan, I don't think so we are going to have a very much clarity on the policies. And then we have a higher inflation in the US. So I think these are some of the concerns basically which are there and which weigh over the market. So I think this is more of a temporary bounce back which we are seeing. I don't think so that bottom has yet been formed.
Okay, bottom perhaps has not been formed, but maybe close by. Kunal is there to perhaps decode that for us. Kunal, what's your sense? A bit of a green on the screen today. Is this something which is going to be durable?
I'm not sure whether it's going to be durable, but yeah, I think it's a decent bounce, and it's a bounce which the markets probably thought that it could be a bit more anticipated because of the way the indicators were oversold. So a couple of days back, I was mentioning that how the market breadth was extremely oversold. There was almost 85% of the stocks in the Nifty 50 mid cap, Nifty 50 mid cap 50 as well as small cap 50, which were trading below their major moving averages, whether it's short term 20 DMAs or 50 DMAs, and in many cases even 100 to 200 moving averages for few indices. So when you have such kind of an oversold market breadth, the market gets back into a process of a bounce. Now, in the process of a bounce, the markets come back into a strong psychological zone in terms of resistances. For example, 23,500 now acts as a more of a support for the index over the near term, and the major resistance which the index should face should be closer to that 24,000 mark. Same would be the case for Bank Nifty. We saw the index trying to come back to that 51,000 levels, but unable to break past about that zone. There has been call writing which is evident at the 51,000 mark for Bank Nifty. So which means now we are looking at 51,000 as a resistance for Bank Nifty. So when you have such kind of a market dynamics, we expect that the markets would probably get back into a retest of the resistance. But how soon and how quickly the markets can break past about those resistances is something which I think we can just about wait and see.
Wait and watch. That's the word coming in from Kunal. But yes, at least for now, there's green on the screen and can't really complain much. Nishal, today it's M&M which is actually doing quite well. This morning, CLSA had come out with a note talking about how they're maintaining their leadership. They have a slew of launches lined up. What's your sense in this stock, or is there any other that you prefer within the four-wheeler category?
No, I think M&M has done pretty well basically. I think not only their PV but also even on the tractor side. I think they have guided for a decent turnaround in the coming 2 quarters. So valuation-wise, also M&M seems to be in a good zone. So I think M&M is a strong candidate there. But I prefer Tata Motors. The correction has been much more severe, and then there is a corporate event which is lined up, basically the splitting of the company. So I so gives you fairly good value basically at these prices. So I think investors can take their pick. My pick remains to be Tata Motors.
Tata Motors, M&M, what's looking stronger and what's looking like a buy right now?
So I think two new additions, Eicher Motors and Ashok Leyland. Actually, these are the two stocks which have confirmed breakout of sorts on the short-term charts. In fact, Eicher Motors is now very close towards the life high levels of 5100, 5150 mark. And the stock has been more sideways. So when you see a stock which is a lot more resilient and doesn't correct with the entire sector or show signs of weakness, then that's a stock which generally gets to get into a breakout first. Ashok Leyland also, I think today the fact that the stock has come back above its long-term averages and it's confirmed a swing breakout, and something which I think not many of the auto stocks have actually confirmed. Even though of course M&M has also seen a bounce from its previous swing lows of 2750, 2800 levels, but I believe that the charts for Ashok Leyland so far, at least in terms of momentum, the volume built up, the indicator positioning, I think that's also quite strong. So maybe I think we could be looking at a phase where the previous leaders of the previous leg of rally for the auto stocks, they could probably take a bit of a pause, and you might see new stocks emerging. I think in that case, Eicher Motors and Ashok Leyland are the two important ones.
Sure. But is the selling going to arrest itself now in Tata Motors?
Doesn't look like, because when a stock gets into such a kind of a sharp correction, even after there is a process of a bounce, there is an eventual retest of the previous swing lows. That determines that whether the stock holds on to that support, or whether you are looking at a durable bottom as well as maybe a correction further for the stock. So right now that sub 800 levels is a zone where Tata Motors has fallen down to. There could be a process of a bounce. You might see maybe a 30-40 point bounce for the stock, but then an eventual retest of that 770, 760 mark is what could determine a major bottom in place. So as of now, it doesn't look like that a major bottom is in place.
Okay, not a major bottom in place yet for Tata Motors. There could be more selling in the pipeline. Look at Ashok Leyland and Eicher Motors in case you want to play the auto pack. Let's look at what's happening with air traffic as well. GMR Airports came out with its monthly traffic data. It's an uptick of about almost 5% in the month of October. They're saying they handled more than 10.7 million passengers across all of their airports. And that's an uptick of almost 9.25% on a year-on-year basis. This is both for international as well as domestic passengers. And then there is Interglobe Aviation. Goldman Sachs has come out with a note. They're maintaining the buy target price of 4,800, which is indicative of almost a 21% upside to yesterday's close. They're talking about October-November air traffic growth at 10 to 11%. They're saying that the PLF as well has grown. The November ticket fares for Interglobe Aviation domestic fares are down. December fares are also down right now. And Indigo has continued to expand its fleet size. So they're pretty hopeful of this. But Nishal, what's the best way of playing this entire tourism and, boom, so to speak, and travel boom, of course? Is it going to be via airports, airplanes, or would you stick by with hotels?
I think hotels have done pretty well. Basically, they are still doing, and you are now getting into a season, at least for the next 2 quarters, where the tourism season for tourists coming from abroad is the best time for India. So I think at least for the next 2 quarters, hotels and along with that, the wedding season, I think hotels is the best way to play. The second thing obviously remains to be airlines. Yesterday, I think first time India, the number has been 5 lakh passengers on a single day, basically. So I think that's a good number basically to start with. And a third way basically could be the luggage sector. That's another sector basically which has done okay till now basically, and I think going ahead could be a good one to play through.
So that's the take coming in as far as some of these consumption and travel related consumption is concerned. But what about the BPC related consumption, Nishchal? And I'm talking about the numbers that we got from Honasa and the kind of dropping it's seen over the last couple of days. And it looks like an isolated case because Nykaa's numbers weren't as bad. Do you track this one? Do you have a view on either the stock or the category?
Yeah, personally, I own it. So I just as a declaration. I'm disappointed with the last quarter numbers because a quarter back commentary was not as bad as the numbers have come out. I think basically there are 2 issues which is the company is facing. Obviously, one was the inventory clearances, basically because they are moving from online to offline. That is one part of it. The second thing I think, and the more worrying part of it is the main brand Mamaearth. Basically, that is sort of degrown. And that's a big issue, basically, because that was growing pretty well and suddenly it has just fallen off the cliff. Now, during the call, the explanation was not very, very clear and the management was still trying to grapple with how to come out of it. So I'm pretty confident they will find a way out. Overall, I continue to believe BDC is still in a good spot. I do not see maybe a quarter or two. Consumptions are low basically, and that's why the whole sector is going through a bit of a turbulence. The problem is with the FMCG, the staples basically, and not with the BDC part. So I would be worried on the staples company rather than the BDC. I think maybe a quarter or two and we will be out of this issue.
Okay, that's the take coming in on Honasa. That stock, of course, has taken quite a bit of drubbing. In fact, since the closest peer is Nykaa, let's try and stack up both of these in the beauty and personal care segment, which has grown over the years, fair enough, but it does come with its fair share of headwinds as well as tailwinds too. Snehi has been collating that data and making that analysis. She joins in with more on her findings.
Well, yes. So let's compare Honasa Consumer with its peer in the BPC, which is the beauty and personal care segment, that is Nykaa Beauty. Before we do that, first up, let's understand the state of BPC, the entire BPC space in India. And if you take a look at the Nykaa Red Seer Beauty Trends report that was released recently, India is the fastest growing BPC market in the world. Now, it's expected to reach $34 billion by 2028, growing at a CAGR of 10 to 11% over the course of that time. And segments that are expected to see the most CAGR growth are skincare 13%, makeup at 12%, hair care at 11%, and fragrance at 10%, which means if you take a look at the macro BPC picture, that seems to be very solid and in place when it comes to India. Some of the tailwinds for the BPC space in India is rising discretionary spends on the back of a rise in disposable incomes. There's also democratization of information and expertise courtesy of social media. You also have universal access because of e-commerce, new formats, ingredients. Gen Z is getting more active with skincare. So all of these reasons are some of the tailwinds that could help the BPC market grow. Now, with this backdrop, let's compare two of the players of the BPC market in India. First up, let's talk about Honasa Consumer. Revenue from operations has come in at 462 crores this time for Q2, which is up 7% on a year-on-year basis. However, they have logged in a net loss and also a net EBITDA loss. So that seems to be very shaky for the company. This is a stock that has been beaten down over the last 2 days. But if you take a look at Nykaa Beauty, only the beauty segment of Nykaa, which is a peer of Honasa Consumer, the GMV is up 29% year on year. You have revenue also that's gone up by 24%, coming in at 1700 crores. So that's a big difference that's coming in between Nykaa and Honasa. EBITDA has also grown. EBITDA margins have also, very nominally shrunk year over year. But that's not a big reason to worry about, because overall Nykaa seems to be doing well. So when you take a look at this report and you compare both of these companies, it really does seem like the problem in the numbers of Honasa Consumer seem to be an internal problem, and the BPC market, however, continues to remain strong. We also caught up with experts like Karan Torani and Hemang Jani, who agreed with the view that the problem with Honasa's consumers' numbers were their internal issues, and they believe that the stock is overvalued. There is hype around the stock and its products. But, well, yes, this is the scenario of Honasa as well as Nykaa when you compare it with the backdrop of the BPC space in India.
Okay, so that's the take coming in. That's Honasa still down 11% in the trading session after that 20% slide. And Nykaa too actually has seen a slide from the highest point of the day. But I think there's a bit of a green on that one. Let's pull up the Nykaa stock and see. So it is in the green, but yes, considerably off the highest point. Nagaraj Shetty also joins us on the show right now to talk to us about the market fundamentals. Nagaraj, today the banking index is seeing a bit of an outperformance of sorts in the sense that the private banking names are doing okay today. HDFC Bank was one of the outperformers, 2% gain coming in there. Federal Bank is 4% higher. What's the view on these select banking names?
Hi, good afternoon. Bank Nifty has witnessed a decent bounce back recently after a sharp fall. The overall chart pattern is indicating the recent downward correction, and the downside breakout seems to be false right now. And I'm expecting some more upside bounce in the banking stock, especially Axis, ICICI banks are looking at the very attractive, and SBI as well. They are placed at the support, and more upside is likely in these counters as well.
Right. Other than that, Nagaraj, what trends are you picking up within the auto pack?
Automobile, Mahindra and Mahindra and Tata Motors are looking positive. Tata Motors, after the decent correction, placed at the good support and bounce back as well in today's session. I'm expecting from this oversold level, one may expect some sizable upside bounce in Tata Motors, as well as that Mahindra and Mahindra is also poised in a good place to show some decent bounces.
Okay, so M&M is one stock which is showing a decent amount of bounce at this point of time. Let's take a look at some of the other buzzers as well. Nugent Software has suddenly spiked 9%. Kirloskar Brothers has been holding quite well. Z Entertainment is just excited by that news that Mr. Goenka is going to step down as the MD, but he is going to continue as the CEO. So not really sure of what's happening there. Delivery is the other one which has been doing well. But the stock that I wanted to talk about right now, Nishchal, is Varun Beverages. And I mean, we should pull up a 1-month chart or a a 5-day chart of Varun Beverages. Since its earnings and the fact that they have made a couple of more acquisitions, that stock has been on fire in an otherwise weak market setup. What's the sense that you're getting on Varun Beverages? Because at one point of time, there was that entire clamor around increased competition and how Campa Cola is causing a bit of disruption, but not really impacting this stock that much. Up what, 48% in 1 month? Oh, sorry, 8% in 1 month.
So I think it's a fairly strong business, and I think Campa and all still, if you really look at it, it's only in a few states and down south. So to really challenge Varun Beverages, I think it'll take a bit of time. I think the other positive news on Varun is basically that they have got another market, I think South Africa, which is also going to be now in Varun Beverages fold. So I think that is what is driving the markets, basically, driving the share price for Varun.
Right. Let's just take a look at banks. Federal Bank, of course, has been hitting fresh highs. Today as well, it's higher by about 4.5%. HDFC Bank has made a meaningful comeback, about a 2% uptick coming in there as well. And then, of course, SBI as well has been giving it due support. That stock also holding up as we speak right now. Axis 1% higher. Kotak also looking up in trade. Flat for ICICI Bank though. Kunal, make the chart comparison for us. HDFC Bank or ICICI Bank, which has a sort of higher move poised in basis the charts in the near term?
I think HDFC Bank stands out over there. So there's been a relative outperformance from HDFC Bank as well as ICICI Bank as compared to the other peers. But when you try and make a price comparison between these two, then I think HDFC Bank over the very recent time frame, the last 2-3 weeks specifically, I think has been trying to come back very close towards the previous highs. 70, 90, 94 approximately is the previous highs for HDFC Bank. This could be the third or the fourth attempt for the stock to break past about those levels. But what's very interesting as a change for HDFC Bank is the correlation with respect to the Bank Nifty moves. So, for example, today the Bank Nifty is higher by some 400-500 points, but the price for ICICI Bank is on the negative side, and we've seen this pattern for the last many days. That ICICI Bank as a correlative stock has the correlation has gone down for ICICI Bank as compared to HDFC Bank. And now, when you see that kind of a divergence at play, we generally expect that the stock is getting back into a zone of consolidation, is not getting ready for a breakout anytime soon, unless the stock breaks past about the first major resistance, which is at 1285 mark for ICICI Bank. I would actually believe that HDFC Bank stands a higher chance of breaking past about the previous highs, and in fact even crossing about the lifetime high levels of 70-90 approximately.
Nishay, is there merit in believing what the charts are indicating right now? Could the leadership within the private banking names have changed to HDFC Bank versus ICICI Bank after what, I think almost 3.5 years?
If you really look at it, I think the banking industry, HDFC Bank has been the leader. Yes, I think on the stock markets, ICICI Bank has been the leader for the last 2 or 3 years. But having said that, I think HDFC is underperformed for a long time now, almost 2 years. And it is time basically, because I think the numbers have been very, very strong in the last now, 2 or 3 quarters now. They have been delivering as analyst expectation or even beating analyst expectation. So I'm pretty confident basically. My money is on HDFC Bank actually to outperform.
So take coming in as far as the banking sector is concerned. For now, we're holding on to the green for the markets, doing pretty okay for the broader markets as well. And the Bank Nifty, holding on to that gain of around 0.8%. Though Nifty has come off a bit from the highest point of the day. A short break and we'll be right back with more.
It's a pleasure and a delight to have Mr. Puneet Chhatwal on ET Now, and today we'll be talking about not Kivas QT, which is not this quarter se quarter tak. We will talk about next 5 years, Panch Varshi Yojana, the 5-year plan of IHCL, and what are they planning, what are the aspirations, and what kind of commitment are they ready to give. I like to remind our viewers that as a policy, Indian Hotel never gives a guidance, but this is some kind of a roadmap which they are essentially sharing with investors and our viewers. Mr. Chhatwal, thank you for joining us. I'll take the clock back 5 years, then we'll talk forward. When you came with your 5-year plan, which ends in 2024, Avana, everyone said it was very ambitious. You achieved it before time. Now you're coming with this plan, everyone is saying it is quite conservative because there's a tailwind in the sector. So what is right, what is wrong? Was the first plan very optimistic which you delivered, or this one is conservative?
Well, Nikunj, firstly, it's always a pleasure to talk to you. But in any journey, you know, you need to have people who believe in the journey, especially people who are within the organization. When we first unveiled Aspiration 2022, way back in February 2018, not many believed, but they said, okay, now we have said it, so we'll do it. Then came COVID, which gave, actually in hindsight, I have to say, COVID gave the confidence. If you could overcome the challenges of zero revenue, lockdown, come back with a bang, and be very prudent with the cost, that gives you a confidence to achieve anything you want. And if COVID does not allow you to get derailed, and you still go ahead and achieve Avan with flying colors, then, you know, anything is possible. Now, what we have tried to do always is find some kind of a science to what we are communicating. We just don't pick up a number and say this is what the number is. Finding the right balance, which is important for an India-centric company in terms of capital light and capital heavy, in terms of luxury brand versus tier 2, tier 3, tier 4 cities, in terms of nation building and just building cash cows. I think there is a lot of science and art that goes behind it. And that's the reason we came up with what we have come up. And in an ideal world, if we could deliver on this promise, even a little ahead of time, like we have done it in the last two roadmaps that we have shown, we would be very pleased as management.
So can I say that the vision is a conservative vision, and you are again following the mantra of under-committing and you want to over-deliver? So these are conservative estimates. This is a baseline number.
No, I think where we stand today, it's a realistic number. See, at that time we were coming from a 12, 13, 16% EBITDA margin. Last year we finished at a little over 33% on consolidated, almost 40% plus on standalone. I think these are very big numbers, and all in all, what is important is that the business model, the mix of locations, the mix of the contract types, the mix of the geography, and at the same time keep moving forward on the global front as the crown jewel of India. I think all these parameters have to be balanced, and I think up till now we have done a good job and hope to do the same going forward.
The simple headline for our viewers is that you would double the number of hotels and you would double the revenue. So what is the maths behind this? Because this guidance is art and a science. Now let's understand the maths.
So the maths is very simple. If you double the number of hotels, normally the revenue should triple or quadruple.
Yes.
But because 90% of the growth will come from capital light, and of that 90%, another 80 to 85% will be through management contracts. As per accounting standards, what we consolidate is only the management fee. The management fee is only like 6 to 9%, depending on the size of the property and the location of the top line. So the rest is not our revenue. That is the owner's revenue for whom we manage the property. So that's why getting to a double in the consolidated reported revenue at an enterprise level is a much larger number. So at an enterprise level revenue, we're talking 30,000 crore plus. But that is very important for our business model, because this will enable us to take out the cyclicality and volatility in our portfolio. As everybody talks, hotel sector is very cyclical, hotel sector is very volatile. How do you take that volatility out and keep marching forward in a very strong way? One of the ways, or one of the levers, is the brandscape, and the other lever is the business model that you are using for your growth.
Now it's adding up, because just thinking through that, if hotel rooms are doubling, then the revenue has to be higher than this. It's the whole enterprise number which would be larger.
But then when the market gets hit and the RevPAR, which is your multiplicator of average rate and occupancy, drops by 10, 15, 20%, then the profitability drops by 50%.
Yes.
So that is, which is something which is gone and is expected to go away further. And in an ideal world, we find the real sweet spot, which is not only good for our portfolio, but becomes a benchmark for the global hospitality industry.
Okay. Now, the last column of the press release mentions 75% of the business will come from traditional businesses, which is your existing model, asset light, as well as company-owned hotels. 25% will come from new businesses. 25% is a sizable revenue. That means on a 15,000 crore, that's 25%. That's a big business for you now. Will that business add to your margins eventually, or it will first eat into your margin and boost it up?
The other way around. It will significantly add, as we have also given the guidance in the past that all the new businesses are expected to do EBITDA margin because it's capital light but does not exclude revenue sharing contracts north of 35%. So north of 35 means more than the margins we have done in the past. So, but that's for 25% of the business. So I think that is a very good and healthy number, and brands like Ginger, like Cumin, are very well positioned to deliver much higher number than that.
When you gave your last 5-year guidance, which is the one guidance, you also shared the margin picture. This time, at least, until unless I've missed it, I've not seen a mention of the margin. Have I missed it, or you've not shared it?
Well, we cannot. One reason is, if I share already this will be the margin and this is the revenue, then you have calculated everything already today. So
that's my job.
So that
margin has not been shared.
Second is, in an ideal world, we keep what we have and improve on it further. As a high growth company with several new businesses, and at the outset you asked this question, will these new businesses be accretive to your total business, or are they going to eat into it and because they need capital to grow, right? We don't need capital to grow in these businesses, but definitely we don't want to lose out on very nice opportunities. I think I always used to talk about the opening of Ginger Mumbai Airport. That's become a new benchmark. See, people heard you, people believed you, but the real conviction came when they actually saw it in black and white, the numbers. So very first 6 months of operation, if it does 50% plus margin and does a revenue of more than 50 crores, and the year is still left, then the picture looks very different. Then you say, okay, now when I'm going to do more such Ginger branded properties in very important markets, in key locations, then we can go for that kind of a number. But we have to first get there. So we reimagined Ginger, which was first launched in 2004, like 20 years ago, and it struggled for a very long period of time because the business model was not right.
I go back to a very basic question, and we keep on going back to again and again. There was this whole world which we use the word, revenge shopping, revenge travel, revenge adventure. You can only live once. All kind of terminology was used to explain the initial comeback in the tourism sector. But for me, what is happening is that for the quarter gone by, car sales were down, apparel sales were down, but hospitality sales have gone up. Is this trend here to stay in incorporating your guidance? You must have taken a view on rates, cyclicality, demand, supply. Where is that headed for 5 years?
I personally believe that there are 3-4 important factors which are going to contribute significantly to hospitality. Number one is your GDP growth. If India becomes number 4 and then aspires to be number 3 economy in the world, it's also going to get all the other attributes that these top 5 economies have. And one of that is long weekends, leisurely trips, business conferences, meetings, etc., etc., etc. Number 2 is, as the country gets richer, then the per capita income increases. If the per capita income increases, the disposable income increases. So that's how the spend comes. Number 3, something which has not yet happened, but at some point it will happen. Just like India's economy became number 5 and is expected to become number 3, India will be an important foreign tourist arrival destination. Today it is not. It is nowhere close to what its true potential would be. It's not even at, I would say, 20% of its true potential. It's 10 million foreign tourist arrivals, of which Indian diaspora is approximately 50%. So I think that kind of factors which are driving demand will drive growth in this sector, will drive rates, will drive profitability, and also the influx of new capital. When Taj started and other companies in India started, they were owner-operator. Then came an era of builders and developers. But the institutional capital is waiting to come in. Global institutional capital, when that starts coming in, that's when the hospitality sector will go through the roof.
I was hoping there would be mention of a market cap in last 5 years, 1 lakh crore. Any numbers where you aspire the market cap should be? How will the journey of 1 lakh to 2 lakh be achieved in the next 5 years? कुछ तो mention करना था, market cap 1 lakh crore हुई है.
नहीं, वो नहीं है, but I think I'll pick up from one of our last interviews almost 6, 8, 9 months ago. You have inculcated that thought in our mind, and if we can become among the top 3 hospitality companies in the world, we should go for it, and we will, as management, do everything to get there. And one of the measures of becoming top 3 is your strength of the brands. The other is the scale. But one of the other attributes could also be market cap. And one way or the other, with Taj being the world's strongest hotel brand, India's strongest brand across all sectors, I think we would be extremely pleased if we not only retain our current positioning but kept improving it. As India grows, Indian hotels grows, and as Indian hotels grows, the backbone of Indian hotels, the Taj brand, grows.
When you measure the peers, there's an absolute comparison and there's a relative comparison. Markets are about absolute comparison, boardrooms are about relative comparison. How would you define your market share in India? Where do you think a market share could move? Have you gained market share in the last couple of years? Because now at the industry level, launches are happening.
Immensely. I think it would be fair to say that today our revenue equals to other industry peers out of India put together. Even if it took other global majors, we are absolutely at par.
What's your number?
As I said, if our total enterprise level revenue is around 10,000 crore or plus, and going forward to 30,000 is what is expected. Today last year we were 13,000, this year we might end up at 14 plus or close to 15. That's a very high number. Just Taj Mahal Palace and Tower might do anything north of 750 crores on the top line.
Which is more than a lot of boutique hotel chains.
Lot of other global companies put together in terms of the management fee they earn in India. So not one, but several put together will not be equal to that revenue or the EBITDA of that one single hotel. So I think all in all, that is the opportunity.
Back with closing trades right here on 89. What a U-turn the markets have taken just when you were rejoicing that 100-point move. What a drastic fall. Not just metals, but look at Reliance. That's fallen almost 2%, and the large chunk of the fall has just happened in the last 15 minutes or so. Similar is the price action on an ICICI Bank. It was lying flat just a few minutes back. ITC, Kotak, some of the technology names, they're all tumbling quite hard in trade right now. But how much more of an India sell-off? Let's try and understand and probe who better than Vikash Kumar Jain from CLSA Investment Analyst India joining in on the show right now on the sidelines of their conference. Vikash, hi. Good to have you on ET Now as always. Tell me, what's the chatter around India at the conference? What are you picking up? Why so much selling here?
Hi, thanks for having me. It's very interesting because we had our Asia conference in Hong Kong not too long ago. This is middle of September. And from then to now, given what the markets have done, discussions have shifted quite a lot. So in September, big complaints from foreigners that market is still very expensive. Now the discussion is more in the territory of, is this a good entry point, or there is more left in terms of the selling in the market? So, and what could be the impact of changes in the global macro with new leadership in the US? So that's really what has been a lot of discussion point. Most of the investors do agree on the long-term India story. The discussion is more about whether this is the right entry point or there is more that we could see to get a better entry point. I think that's really what the discussion has moved to.
Do you think it's just a India valuation problem, or is it more money moving out of India to maybe other emerging markets or even the US?
So what one needs to understand is where are we getting money from? And this is my favorite statistic that I keep highlighting, that of the $900 billion that is invested by foreigners into India, 90%, over $800 billion, come from money which has freedom to move from one market to another. So foreign money will always have influences of what they see in other competing markets. Early part of October and through large part of October, it was to do with suddenly China waking up, the concern whether China has more legs, and maybe that created a competition for this money. The second level of competition came from end of October to early November onwards, as we were trying to get into the Trump trade, and after the election results in early November, there's been competition of money moving out from the broader EM basket into the US basket. And all through this period, one overlaying competition has come from the primary market. I mean, we've had quite a few listings. We've raised about, at a time when foreigners have taken out about $13–14 billion, we've raised $6 billion or so from primary markets in this quarter. So there are all of these competing forces which have been in operation for the flow into the Indian secondary market. How do we see these forces panning out? I think the China part of the worry is kind of addressed for now because there's more nervousness on China with Trump coming in than excitement. Their initial reaction of the policymakers over there hasn't really satisfied the expectations of the market. So that part of the trade is for now on pause at least. The US part of the trade, I would argue, the initial euphoria of Trump coming in and money moving in favor of the US and away from EM is something that is on works and possibly coming to an initial pause as well. Because if you see the macro setting, after he came in, he announced a few of important people will be part of his administration. That created another level of surprise. There was a euphoria. And then the next leg of news from there is only going to come after his inauguration on 20th of January. So that's a January event. So I would say the initial part of that move is also done. Then the third side of competition has come from the primary market. Now this is interesting because if you look at the first 9 months, we saw about little less than 70 IPOs in the first 9 months of this calendar year. And the median listing gain, that is the first day gain versus the IPO price, was 30% for those IPOs. In this quarter, other than one IPO, all the other IPOs have seen nowhere close to 30% gain. So suddenly the overall, maybe the frothy excitement in the IPO market, you can also see in gray market premiums kind of vanishing and not so much excitement when new issues get listed. I think that part of the supply is also kind of cooling off. So a lot of these competition for flows into the secondary market are cooling off. That's why our recent report that we came out with just yesterday, our note called Dominarative, where we talk of, it's titled, No News is Good News. We believe that we could be in a macro lull period for a period of about 1.5–2 months, and that could at least be some kind of an interim rally which could happen. Whether this is start of a next leg of the bull market or this is just a rally within a larger correction is a difficult question for us to answer. But at least a rally going into December, which is anyways a seasonally strong month, is something that we cannot rule out.
That's why you had reversed that call on India with that overweight coming back to 20%. But, Vikash, you're talking about that Santa Claus rally. But what's getting undone in the market today as well, this worry regarding geopolitics. As we speak, there are headlines coming in that Ukraine has attacked Russia. It's made the first ATACMS strike inside of Russia and seems like tensions are escalating. If that does happen and the tensions escalate from here on, what happens to India? What happens to flow? Is it going to be a case that will be back to domestics, or how should one position themselves then?
I think, events like those simply highlight that whatever people are expecting, in terms of a lot of things getting sorted out in favor of the US with President Trump coming in, is not all straightforward. I think this is typical to a lot of such event-based rallies. We've had our periods of election-based rallies where the fact is reality is generally not something which changes just with a magic wand. It takes its time. In fact, one of the things which was being talked about over the last week was perhaps a negotiation. Many macro commentators thought that a win with a peace negotiated between Russia and Ukraine in a manner which is more acceptable to both the parties is something which could be one of the first things that President Trump will focus on. But as you can see with many such events, not all of this is something which is very obvious, very easily controllable. So it just tells out that, yes, you've had a euphoria rally, but not all solutions will be immediate. So I think it just brings out that there is a period of unpredictability with a lot of, lot of policies that the president has set. So, reality might not be as dramatic as what such election-based rallies make market to price out.
So, yeah, it's not going to sort themselves out with a magic wand, but something which was doing well for us was earnings, Vikash, and that was the, the saving grace of sorts that made the valuation somehow acceptable, because at least we were that, growth at that reasonable price kind of argument. What happens to it then? Is it completely getting undone, or this is just a realistic moderation that streets should have seen coming?
So, so we had turned, so we have this proprietary India Bull Bear Index, which had given a sell signal late September, and we had turned quite bearish in a report that we had done, where we were thinking of this being another worry. I would say there are a few elements of the earnings growth story which we should kind of spell out and separate out. The first part is expectations. Yes, there are certain areas where expectations are quite high, but at the same point of time, there have been some self-goals that we can possibly sort out in the second half of this fiscal. Like government spending has been down on a YOY basis in first half. Second half could look much better, because if they were to stick to their annual budget plan, then government spending could be up 14% on a YOY basis for second half. Similarly, we've had two really bad inflation prints, and perhaps with those being behind us, we see much higher base for the next November and the December month. Maybe inflation will look much better for those 2 months. That might allow RBI to get less hawkish. So a lot of those things could also create some positivity, but I think there is a part which was higher expectations cooling off. There is a part which might correct, plus excessive rain, limited activity. So yes, earnings, if you have inflated expectations, could be disappointing. But in general, that typical 10 to 15% broad earnings growth story in India is something which is not going away. But there are times when we start expecting much more, and that's where there could be that corrective phases for expectations that might happen in the market.
Vikash, great to have you on the show, and thanks as always for making time.
Thank you. Thanks for having me.
Okay, that's the word coming in from Vikash Kumar Jain from CLSA India on the sidelines of their conference. Let's just mark where we are headed in for a close, and it's quite a tumble actually. We've seen quite a fall from the top of the day. I mean, to think of it, we were standing well in the green, built it up very nicely, and now we're closing in absolutely flat. Kunal, what's the price action in the last half an hour telling you?
Well, it tells that maybe the market is not yet settled, the volatility is not yet out for the index, and we could be looking at the index grappling back into a trading range hit again. But the only good part, which we can probably hopefully expect, is that the volatility should subside. So from a 17.5 or India VIX or 17 plus India VIX, if we settle down to say 14, 15 on the India VIX or sub 16 for the India VIX for the next couple of days, that itself should be a sign of maybe some abatement of volatility.
Okay, and with that, let's wind up in trade. Reliance, that's down about almost 2% in trade. You've got SBI as well, which has been quite the drag in today's trading session. I can see Hindalco, HDFC Life, SBI Life. The insurers, of course, are a weighed-in lot. ONGC down about 1.5%. Maruti knocked off about 1%. ICICI Bank saw quite a fall from the top of the day. 0.7% lower is where it's starting shop. Similar price action for L&T as well. And if you just mark the intraday graphs of most of these stocks, the fall has come in just the last half an hour or so, and a very steep fall at that. Similar for the Nifty and similar for all these movers in trade. BEL, NTPC, ITC, Unilever, Britannia, all of them closing in with losses. But some of them did manage to hold out in the green as well.
Yeah, you have Vega, for instance, which is up 7.5%. Triveni Turbine managed to end in the green with that gain of 6%. And Z Entertainment, which had been doing well since the start of the trading session, ends off the highs but comfortably in the green. Even the likes of Jyoti, CNC, EID Parry, Vijaya Diagnostics, these were some of the other names that we are watching out for. Suzlon Energy got that thumbs up from Morgan Stanley, 5% higher on that one. A good kind of show coming in from Imami, Kalyan Jewelers, Delivery. So these were some of the stocks in the green, while on the losing side, Honasa Consumer and Thermax were battered, and so was the entire insurance space. But that's how we are wrapping up this day. Thanks so much for tuning in. Stay tuned to ET Now.